Good evening. I want to say thank you to John Bryant and to Operation Hope. At least I think I want to say thank you.
Excuse me 1 second. Ladies and gentlemen, the Vice Chairman of the Federal Reserve of the United States of America, he didn't come at 2 in the afternoon. This is dinner time. He should be at home with his family. He came here just for this. Can we give him some love one more time? The Vice Chairman of the Federal Reserve.
Thanks, John. Well, thank you. I do want to say, notwithstanding how glad I am to be here, I can't quite believe that my old friend John Bryant set me up that way. There is a basic rule of public speaking, which is never follow the youth entrepreneurs. After all of that energy and optimism and potential, there is no way that this is not going to be boring and anemic by comparison. But I commend our hosts for bringing together such an impressive group of speakers and attendees. All of them are diverse in their perspectives, but all of them share the important goal of advancing economic opportunity and inclusion. It's fitting that this event is being held on the 50th anniversary of several notable prior events, including the publication of Dr. Martin Luther King's last book, Where Do We Go From Here? Chaos or Community?, which urged unity in order to create freedom of opportunity, as well as the enactment of the Fair Housing Act of 1968, which enshrined our nation's commitment to equal access to housing. These milestones remind us of the progress we've made up to now, as well as the challenges that remain, and they inspire us to persist in our efforts. So this conference has a robust agenda ahead of it. Over the next few days, you'll be discussing many issues related to financial inclusion, housing, small businesses, workforce participation, and other topics to which we at the Federal Reserve share a commitment with you. And we view those issues as critical to our mission. Our economy, the whole economy, is stronger when everyone has a chance to contribute fully and to share in our national prosperity. And I personally believe that financial inclusion helps us realize a founding notion of our country, that this is a place where opportunity, innovation, and productivity are encouraged and rewarded. I'm particularly pleased to see on the agenda of this conference a number of sessions on issues to which we at the Federal Reserve devote considerable attention: access to credit and financial inclusion for consumers and for small businesses. Conversations like these are enormously important to understanding the challenges that Americans face and why a multitude of voices and approaches are needed to address them. In my remarks tonight, I'd like to focus on the consumer protection and credit accessibility aspects of financial inclusion and some of the ways that the Federal Reserve promotes a fair and transparent financial services marketplace. In some of my recent remarks, I've emphasized my view that we should aim for an effective safety and soundness regulatory approach that is as efficient, transparent, and as simple as feasible. I consider these principles to apply equally to our consumer protection supervision program. That is, we should strive to promote consumer protection with as much efficiency, transparency, and simplicity as possible. I think a commitment to these principles is not only compatible with including everyone in our financial system, but in fact helps promote it. If the burden of regulation is too great, it makes it harder for institutions to serve their customers and their communities, all of their communities. And this is especially the case for community banks and for minority depository institutions. These play an important role in serving the needs of their local communities, including historically underserved populations. And I'd also like to share tonight some thoughts on an area to which I've devoted a good portion of my career: the importance of small business access to credit, which is a critical part of financial inclusion and a catalyst for economic growth in local communities. So let me start with the foundation of why financial inclusion is important. In broad terms, what I'm talking about when I say financial inclusion is access to affordable products and services that meet the needs of individuals and businesses and that are delivered in a responsible way. At the Fed, we recognize the influence that financial inclusion has on the broader economic performance of our country. Including everyone in the system is essential to advancing the Federal Reserve's goal of promoting maximum employment, as well as supporting the stability of the financial system. Likewise, we support and share your goal of ensuring a fair and transparent marketplace for financial products and services, including credit, that can provide a pathway toward economic prosperity for all Americans. Overall, our economy is performing well right now. Unemployment is low. But many households and communities continue to face financial challenges. Consider that more than 2/3 of white households own their homes, as compared to less than half of African Americans and Hispanics. And consider that all-important human asset, education. 1/3 of white adults have at least a bachelor's degree, as compared to 1 in 4 African Americans and 17% of Hispanics. This matters because the advantages of a college degree for accumulating income and wealth are lifelong and intergenerational. They affect not only the individual, but his posterity. We likewise see evidence of financial disparities in the Federal Reserve's Survey of Household Economics and Decision-Making and Survey of Consumer Finances, which are two sort of groundwork surveys that the Fed does on data concerning the economy. When individuals have unequal or insufficient access to financial products and services, such as credit, they may be deprived of a chance to fund an education, to finance a business, to own a home. Opportunities that can provide greater financial security for themselves and their families and future generations. As a nation, we are then deprived of the benefits of their potential contributions to the economy. Now, in the context of my earlier discussion of financial inclusion, there are federal consumer protection laws that are critical to ensuring that consumers are treated fairly when they're offered financial products and services. Discrimination and deception have no place in a fair marketplace. Practices such Those practices can close off opportunities, limit consumers' ability to improve their economic circumstances, including through access to home ownership and education. So the Fed's Consumer Compliance Program reflects our commitment to promoting financial inclusion and ensuring that the financial institutions under our jurisdiction fully comply with applicable federal consumer protection laws and regulations. Let me give just 2 examples involving the Federal Trade Commission Act's prohibition against unfair or deceptive practices in products and services that will undoubtedly be familiar to this audience: student financial aid and mortgage lending. In the last few years, the Fed has addressed deceptive practices in these areas through public enforcement actions that have collectively benefited hundreds of thousands of consumers and given those consumers millions of dollars in restitution. In the financial aid context, Our actions required restitution for students who were not given full information about the potential fees and limitations associated with opening deposit accounts for their financial aid refunds. And in mortgage lending, our action required restitution by a bank that had given borrowers the option to pay an additional amount to purchase discount points to lower their mortgage interest rate, but that did not actually provide the reduced rate to many of those borrowers. As we mark the 50th anniversary of the Fair Housing Act, the fair lending laws remain critical in fostering vibrant communities and a fair consumer financial services marketplace. For all state member banks, we at the Fed enforce the Fair Housing Act. And for all banks of $10 billion or less in assets, we also enforce the Equal Credit Opportunity Act. Our examiners evaluate fair lending risk at every consumer compliance exam we conduct. Now, not surprisingly, we find that the vast majority of the institutions that we supervise comply with the fair lending laws. But we are committed to identifying and remedying violations when they occur. Pursuant to the Equal Credit Opportunity Act, if we determine that a bank has engaged in a pattern or practice of discrimination, we refer the matter to the Department of Justice. Federal Reserve referrals to the Department of Justice have resulted in public actions in critical areas such as redlining and mortgage pricing discrimination. For example, in our redlining referrals, the Fed found that the banks treated majority-minority areas less favorably than non-minority ones, such as through lending patterns, marketing, Community Reinvestment Act assessment area delineations. For our mortgage pricing discrimination referrals, the Federal Reserve found that the banks charged higher prices to African American or Hispanic borrowers than charged to non-Hispanic white borrowers, and that the higher prices could not be explained by legitimate pricing criteria. Consumers deserve to be treated fairly, regardless of the size of the banking institution. But we at the Fed believe we can achieve this goal and still reduce regulatory burden on the system, which is important in ensuring that the system can in fact comply and provide support to the real economy through a balanced program of tailored and risk-focused supervision. Accordingly, we continue to seek opportunities to promote efficient, simple, and transparent supervision where possible, so that the institutions we supervise can focus on finding solutions that work for all consumers and all communities. To promote consumer compliance, our community bank supervisory program focuses our examinations on the areas of highest risk. That's improved the efficiency and effectiveness of our examinations, and it's reduced the burden on many community banks and minority depository institutions. Banks and consumers benefit when supervision is timely and effective. Put simply, our role as supervisors shouldn't be to play gotcha with our banks, but to support their compliance efforts so that they are in fact successful, so that they achieve the goals that we all want to achieve. The Interagency Consumer Compliance Rating System, which was published in November of 2016, is an example of this approach. This guidance, which we've issued, provides incentives for institutions to focus on managing their consumer compliance risks, preventing consumer harm, and helping to create a culture that identifies and corrects problems. Another example of how we support our institutions is how we work with our minority depository institutions, or MDIs. As I noted earlier, they play an important role in serving the needs of their local communities. We have dedicated Reserve Bank staff who are in frequent contact with MDI leadership. Based on what we've learned in the course of this outreach, we've expanded what we call our Partnership for Progress. That's a program for outreach and giving technical assistance to minority depository institutions. And that includes our staff from our community development function now. And we've enhanced our MDI-related programming. Our commitment to transparency also includes a robust outreach program for banks. This includes Consumer Compliance Outlook, which is a widely subscribed Federal Reserve System publication focused on consumer compliance issues, and its companion webinar series, Outlook Live. For example, in 2017, last year, we sponsored an interagency webinar on fair lending supervision with almost 6,000 registrants, a substantial share of which were community banks. Let me now turn to small business access to credit. At the Fed, we view small business credit from several perspectives. For the economy as a whole, small businesses need adequate and affordable credit in order to form, grow, and succeed. Otherwise, they may underperform, and that slows growth and employment for the whole economy. For many small business owners, personal and business finances are intertwined. A well-functioning housing finance market, for example, is vital for small business owners who may draw upon the equity in their homes to fund their businesses. Student loans may be needed to help fund the education that's important for both small business owners and their employees to boost profits and productivity. And short-term credit matters for day-to-day management of cash flow, while longer-term credit is essential for capital investment. So entrepreneurs, just like consumers, need access to a variety of credit sources. Recently, I had the pleasure of meeting a group of small businesses from across the country at the headquarters of the Federal Reserve in Washington. Now, by small, I mean some of these companies have just a handful of employees. The group included owners of a catering company from Dallas, a mechanical engineering company from Philadelphia, a marketing consulting firm from Cleveland, a combination bar and bakery from Brooklyn, and a gluten-free bakery from my hometown, Salt Lake City. They shared with me the joys of running their own businesses, of creating jobs, and of providing for their families, as well as creating opportunities for their employees. And they also spoke of their challenges, which I'm sure are familiar to many of you in this room. For one, the owners wear many hats, just like our youth entrepreneurs tonight: CEO, Chief Operating Officer, Chief Finance Officer, Head of Sales and Marketing, and some, quite literally, Chief Bottle Washer. They also spoke of the day-to-day difficulties of finding, training, and retaining employees. And they raised the challenges they often face in gaining access to working capital, the lifeblood to sustaining and growing their businesses. The anecdotes I heard touched on three related trends we've been observing in the small business credit environment. First, although lending standards have eased since the recession and the financial condition of businesses has improved, some small business credit needs, especially for the smallest of firms and minority small business owners, continue to go unmet. The 12 Federal Reserve banks that constitute the Federal Reserve System conducted a small business credit survey in 2016 and found that some small businesses still face persistent credit gaps, even though they often seek credit in small amounts. Of the firms that apply for credit, more than 2/3 apply for less than $100,000, with substantial numbers of these applying for less than $25,000. But smaller firms often struggle to qualify for bank credit. And among firms that were denied, low credit scores and insufficient credit history were the most frequently cited reasons. In addition, our work suggests that some low credit risk minority and women-owned firms, and I stress these are low credit risk firms, are less likely than similarly low risk white-owned and male-owned firms to receive financing. And if they are approved, it's for less than the amount they sought. Second, there have been shifts in the composition of commercial bank lending to small businesses. Large banks' share of small business lending has grown, especially among the smallest loans. Now, this represents a change from 20 years ago, when small businesses relied more on a relationship with local community banks for access to credit. For loans under $100,000, small banks of less than $1 billion in assets now hold a 19% share, down from a 60% share 2 decades ago. Today, it's the largest banks, those with more than $50 billion in assets, that account for more than 60% of small business lending. Now, some of this trend may be due to industry consolidation, which has reduced the number of very small banks. The composition of credit offered also is shifting. Loans entail high fixed costs that are roughly the same regardless of whether a loan's for $100,000 or $1 million, and that reduces the profitability of smaller dollar loans. Our data suggests that the growing share of small business lending at larger banks may be partly due to their use of automated underwriting for credit cards. By providing credit cards, banks are expanding credit available to small businesses. But some small business advocates note that this form of credit is generally more expensive and lacks the flexibility of other products. Just as an example, personal or business credit cards may be suitable for purchasing supplies, less suitable for payroll. In addition, the automated approach of underwriting the extension of credit on a credit card may be more cookie cutter, meaning that firms that don't meet standard lending criteria but that nonetheless may be creditworthy may not qualify. These developments have created a space for the third trend we've been observing, the emergence of non-bank online alternative lenders that provide small dollar business credit. For example, some of the large technology firms are providing credit at a rapidly growing pace to their built-in customer base of merchants. Several of the businesses I met with mentioned that they'd turned to non-bank online lenders after being turned down by banks. Some online lenders obtain access to a prospective borrower's accounting software, merchant accounts, shipping and payroll data in real time in order to underwrite their businesses. Business owners can receive funds in a couple of days, even a couple of hours. Now, this emergence of online lenders is part of a broader evolution of financial technology, or fintech, as seen in a wide range of products and services for both consumers and small businesses. So I'm not surprised to see this important topic on your conference agenda. The use of fintech to expand access to credit across all communities has great promise and also associated risks. For example, online origination platforms and more sophisticated credit algorithms may enable credit to be underwritten and delivered in a manner that's still prudent, but with greater efficiency, convenience, and lower processing costs. And as regulators, we do not want to unnecessarily restrict innovations that can benefit consumers and small businesses. At the same time, our interest is in ensuring that banks understand and manage their risks when introducing new technologies or partnering with fintech companies, and that consumers and small businesses remain protected. This is why the Federal Reserve has been engaged in a broad and multidisciplinary effort to develop a robust understanding of the technologies and activities in this space, and to assess policy and supervisory implications. Fintech is also one of the factors driving calls for regulators to modernize the Community Reinvestment Act, or CRA, as technology changes how financial products and services are assessed. As I'm sure most of you know, the CRA is an important law that recognizes banks' affirmative obligation to meet the credit needs of the communities they serve. The CRA promotes financial inclusion by encouraging banks to extend mortgages, small business loans, and other types of credit. Finally, I'll note that we will continue to learn about issues concerning financial inclusion through the research of the Federal Reserve, such as by collecting new data in our survey of household economics and decision-making and survey of consumer finances that I mentioned earlier. The information we gather helps us better understand factors affecting consumers and households, including low and moderate income and historically underserved populations. Thank you again for inviting me to speak at your conference as we mark the notable anniversaries that this year brings. Together, our work together clearly has a great deal of synergy, and I thank you for your efforts. Making the economy work for the benefit of all Americans, including lower income communities, is of the utmost importance. Thank you again.